If you like dividend stocks, and I like dividend stocks, I like high growth stocks too as well, but I like to have a mixture of stocks, and so I like dividend stocks. And if you like dividend stocks, I think dividends where they're paying you out quarterly income is great. Well, that's terrific. Then you want to look at dividend stocks, and they've got a couple ratios that are very, very, very important when it comes to dividend paying stocks. If you're buying stocks that pay no dividend at all, well, then you can just forget this part. You don't need to evaluate it. This is only looking at stocks that are paying out a dividend. And one of the first things you'll look at is the dividend yield. You can get that off the income statement and the most recent stock price. And the formula behind that is you're looking at the dividend per share and dividing that by the price per share. Remember, everything's on per share basis. So how much are they paying in dividends per share stock that's out there, and divided by the price per share, and that will give you the yield or a percentage. And if you think about companies, dividends are the primary way that they actually give money back straight to the shareholders, to the owners of the company, you and I who own the stock, let's say, on a stock exchange. Of course, the other way is that we buy at a certain price and we hope that price grows over time, and then at some point we'll sell that and capture that capital gain by what we sold at the top there is the idea. Hopefully it doesn't go down below what we bought it for, but the idea is we get that capital appreciation. But dividends are things that are taken out of current earnings and are just money that's given back right directly to shareholders, so you can get that regular income. So if you're looking at that from a dividend yield standpoint, or getting that regular income, you'd be interested in a high dividend yield. If you're comparing two stocks and one has a dividend yield of, let's say, 2%, another one has a dividend yield of 5%, for, let's say they're in the same industry and everything, then you would want to look at that and say, wow, for every dollar of share, for every share I have of that, I'm going to get basically 3% more with this other stock. I get a 5% yield versus a 2% yield. One way you can even think of it is almost like interest, right? You put money in a savings account, you get 1% or 2% interest on your cash. It's kind of a similar thing. You're getting that 5% versus your 2% back on that dividend yield. So higher dividend yield companies means more money for you when you put your money in basically in that quarterly dividend. You're going to get that on a yearly basis, that percentage back. So if it says 5%, that's usually like an annual or yearly calculation that you'll get 5% of your money back by owning it, like passive income through dividends. And so dividend yield is a great way to compare companies within the industry, particularly if they pay a dividend. That's where you're really looking at that pay a dividend. Now, a couple of things around dividend yield to be cautious of or be aware of. One is sometimes you might have companies that have a very high dividend yield. They're really outside the norm. They might be paying a 10% dividend yield where everybody else in their industry is paying a 2% dividend yield. And you'd be like, wow, why don't I buy the companies that are paying the 10% dividend yield? Makes sense. You're getting so much more money. In fact, why don't I put everything in that 10% dividend yield if I can get almost a guaranteed 10% back every year? And that's the problem, is the guarantee part. Remember, dividends are not guaranteed. A company could cut their dividend at any time. And what can happen is once a dividend yield goes way up like that, a lot of times how that's happened, if you think about it from the numerical or ratio aspect, it means their prices probably drop dramatically, maybe very quickly. Their dividend has stayed the same, so they're still paying that. But because the prices drop so fast, their dividend ratio is a higher percentage because the price is lower and the dividends stay the same. They don't go down together or rise together. The dividend is more of a fixed thing. It stays the same. So thus you get the higher dividend yield. The prices come down. Now you could buy that stock and a couple of things could happen. One, the price could continue to go down, which could really hurt your ability to have any capital appreciation. And if they don't cut the dividend, well then you would get that dividend. Maybe you could hold that for a long term and at least you're getting the dividends, but you're not getting the combo of both capital or price appreciation and dividend appreciation. But also what happens when stocks have a very high dividend yield, that means their stock price has gone down, and probably for a reason. Maybe they're struggling with earnings, or they're looking at bankruptcy, or something is going on that's causing a nervousness with that stock and the price is plummeting down. And one thing that maybe people are afraid of is that they'll cut the dividend or eliminate the dividend totally. Dividends aren't guaranteed. They can be cut at any moment. And so sometimes you see these high dividend yield stocks where the price has gone down, the yield has gone up in comparison, and then the company comes out and says, oh, we've got to cut or eliminate our dividend. We're on hard times. We're having a hard time making our payroll or paying our bills, so we're going to eliminate the dividend. And then what happens? You get no dividend, so that's no good. And then the stock price usually plummets really fast, even further, 20, 30%, even more, because anybody who bought that stock originally for that dividend is now probably exiting out. So it's something you might be able to hang on to for a long time if you think it'll come back, but that could be a long road. So if you're looking at something and saying, well, it's got a high dividend yield, that looks great, just in comparison to the industry, just be a little cautious on that and really look at the company and how they're doing and how overall things, if they can maintain that dividend, will be the key thing. And then there's a ratio that actually helps us with that, and that's called the dividend payout ratio that we're going to look at next. So I know when I look at dividend companies, I look at how long have they paid that dividend, so are they consistent payers? I then, and are they safe? I then look at the dividend yield to see what's going on with that. And then I look real close at this dividend payout ratio. That'll be a real help for you to see, like, what are my chances that dividend's going to continue to be paid? And that's what we're going to look at next. And a real key thing with dividend stocks, dividend payout ratio.